$1 billion vanished in 18 months. Not in a war, but in a grocery cart. In the late 1990s, the internet was a wild frontier, promising to revolutionize every aspect of human life. From books to pet food, venture capitalists poured billions into audacious startups, each claiming to be the next Amazon. This era, known as the dot-com bubble, fostered an environment of irrational exuberance, where ideas, no matter how outlandish, could attract astronomical funding. Among the most ambitious, and ultimately most spectacular, failures was Webvan. Founded in 1996, Webvan wasn't just another online retailer. It aimed to completely reinvent how America bought groceries. Their vision was simple yet revolutionary. Order fresh produce and pantry staples online and have them delivered to your doorstep within a 30-minute window of your choosing. This wasn't just about convenience, it was about efficiency. Webvan promised to cut out the supermarket middleman, buying directly from suppliers and delivering from highly automated warehouses. They would own the entire supply chain, from procurement to the final mile, a strategy that would prove both their greatest strength and their fatal flaw. The company's leadership was equally ambitious. Its CEO, George Shaheen, was lured away from Anderson Consulting, a global powerhouse, with a staggering compensation package. He brought with him a reputation for operational excellence and a belief in large-scale, enterprise-level solutions. Webvan quickly attracted an unprecedented amount of capital. Private investors poured hundreds of millions into the company. Then, in November 1999, at the height of the dot-com fervor, Webvan went public. Its IPO raised $375 million, valuing the company at an astonishing $4.8 billion on its first day of trading. The market was captivated, but the promise overshadowed the practicalities. To fulfill its ambitious vision, Webvan needed infrastructure. Lots of it. They planned to build 26 massive, highly automated distribution centers across the country, each costing upwards of $30 million. These weren't just warehouses. They were highly sophisticated logistical hubs, designed by engineers from NASA and the military. The sheer scale of this undertaking was staggering. Each center was a marvel of engineering, featuring miles of conveyor belts, robotic sorting systems, and climate-controlled zones for everything from ice cream to organic kale. The goal was to process thousands of orders daily with minimal human intervention, ensuring freshness and speed. Yet a fundamental flaw emerged early on: the cost of acquiring a single customer. Webvan spent heavily on marketing, offering enticing discounts and free deliveries. While this brought in users, the average order size was often too small to offset the enormous operational expenses. The unit economics simply didn't add up. One concrete example: a customer might order a single carton of milk and a loaf of bread. The cost of picking, packing, driving a climate-controlled van, and paying a driver for that small order far exceeded the profit margin on the groceries themselves. It was like sending a cargo plane to deliver a single letter. Adding to the financial strain was the company's rapid expansion. Instead of perfecting its model in one city, Webvan tried to roll out its complex infrastructure across multiple major metropolitan areas simultaneously. This stretched its resources thin, leading to operational hiccups and escalating costs before any single market became profitable. The company also made a critical miscalculation about consumer behavior. While the idea of online grocery shopping was appealing, the practicalities of choosing fresh produce without seeing or touching it, or dealing with substitutions, created friction. Many customers still preferred the tactile experience of a traditional supermarket. By early 2000, the dot-com bubble began to burst. Investors grew wary of companies with high burn rates and no clear path to profitability. The easy money dried up. Webvan, with its insatiable appetite for capital, found itself in an increasingly hostile financial environment. Despite a last-ditch effort to merge with its competitor, home grocer, Com, in an all-stock deal valued at $1.2 billion, the combined entity still faced the same underlying problems: massive overhead, thin margins, and a consumer base not yet ready for its proposition. The merger only delayed the inevitable. In June 2001, just 18 months after its high-flying IPO, Webvan declared bankruptcy. It laid off over 2,000 employees and liquidated its assets, including its state-of-the-art distribution centers. The company that had once been valued at nearly $5 billion was now worth pennies on the dollar. The collapse of Webvan became a cautionary tale of the dot-com era, a stark reminder that even the most innovative ideas require sound business fundamentals. The promise of online groceries was real, But Webvan's execution was catastrophically premature and overly ambitious. So, what can we learn from Webvan's spectacular implosion? Firstly, scale must follow proof. Webvan tried to scale a model that was not yet proven to be profitable in even a single market. This go big or go home mentality proved fatal when going big meant burning through cash at an unsustainable rate. Secondly, unit economics matter. No amount of venture capital can sustain a business where the cost of delivering a product consistently exceeds the revenue generated from it. Webvan's delivery infrastructure was too expensive for the low-margin grocery business. Thirdly, timing is everything. While Webvan's vision was prescient, the market, technology, and consumer readiness simply weren't there yet. Broadband internet was still nascent, mobile commerce was non-existent, and consumers were not accustomed to delegating grocery selection. Today, online grocery delivery is a thriving industry, dominated by companies like Instacart, Amazon Fresh, and various supermarket chains. They learned from Webvan's mistakes. Instead of building massive, expensive proprietary infrastructure, many leverage existing store networks or use a gig economy model for delivery, minimizing capital expenditure. The Webvan story is a testament to the fact that a brilliant vision, even with immense funding and top talent, can falter without a robust, financially viable operating model. It was a pioneer, but a flawed one, laying the groundwork for others to eventually succeed where it spectacularly failed. The allure of disruption often blinds investors and entrepreneurs to the mundane realities of profit and loss. Webvan, for all its technological prowess, ultimately couldn't escape the basic laws of economics. Its legacy serves as a powerful reminder that innovation without fiscal prudence is merely a pipe dream, destined to implode, leaving behind a crater of lost capital and dashed expectations. Uncover another historical financial downfall in our next investigation.